Hello guys, so in today's lesson we're going to be talking about liquidity. Liquidity pools. When can we anticipate raids on liquidity? Some people talk about sweep on liquidity, but we're just going to be using raid on liquidity. What are liquidity pools and when can we anticipate raids on liquidity? So basically, we're talking about how smart money traders manipulate markets so that they can take advantage of retail traders. So let's first of all start with defining what is liquidity. So liquidity is the open interest of buyers and sellers in the market. The open interest of buyers and sellers in that particular market. So what you would normally see is this. At a particular market price, so in our example, we're looking at volatility 75 and the current market price, assuming that it's at 432,000. So that's the current market price or the market price or the current price. So what you would see is this. Most retail traders are taught to buy at a breakout. So that means if price is going to move above the current market price, retail traders are going to be buying. So we have buyers above the market price. And in other cases, retail traders would also want to sell below the market price. So retail traders are looking forward to what? To buy at the breakout when the price is now moving upwards. Probably there was a continuation pattern, or probably there was a breakout. So there's a breakout and retail traders are looking forward to what? To buy. They are going to place their pending orders in the form of buy stops. So a buy stop is normally placed above the current market price. So this is what retail traders are looking for. They want to buy when the price has managed to break out from that market price. So above market price, retail traders are they are looking forward to what? To buy. This is where their interest resides. They want to buy above the market price when there is a breakout. And we also have another situation where if price moves below the market price, retail traders, they are also looking forward to what? To sell. So these retail traders are looking forward to sell below the market price. So basically that's how you would look at the price. So in most cases, when you look at the market, if you can't identify where liquidity resides, you are the liquidity. Liquidity, basically, we are looking, when we look at the chart, we talked about this in our previous discussion, that the market is only moving to do two things. One, to grab liquidity, and also to fill up an imbalance. So basically, we're now looking at that part where the market is moving so that it can what? It can grab liquidity. And this liquidity resides in pending orders. These pending orders, they can come in the form of a buy stop, which is above the market price, and they can also come in the form of what? A sell stop, which is below the sell below the market price. So the sell stops are below the market price, and retail traders, they are waiting for price to break out from that current price, and they want to buy above the market price, and they want to sell below the market price. But when it comes to smart money traders, they want to exploit this analysis. They are looking forward to exploit this analysis. They want to exploit that analysis that retail traders, they want to buy above the market prices. Because in trading, using common business senses, you want to sell when the price is high and you want to buy when the price is low. So basically, that's normal business sense. You buy when the price is low and you sell when the price is high. So this is the understanding that smart money traders have. But with retail traders, they want to buy when there is a breakout. So if the price breaks above the current market price, they buy. If the price breaks below the market price, they sell. They use this in the form of pending orders, a sell stops or a buy stops. And those buy stops or those pending orders, they are what we call liquidity. The smart money traders, they want to grab that liquidity. So when we're looking at smart money traders, they sell at a premium. They are selling at a premium which is above the 50%. So if you take your Fibonacci and you measure, so I'm assuming that this is a price range. If you take your Fibonacci and you stretch it above the 50%, smart money traders, this is the premium territory. So when the price is above the 50%, that's when these guys, the smart money, wants to sell. When the price is below the 50% of the Fibonacci, these smart money traders, they view it as a discount and they are looking forward to buy. So whenever you are buying or you are selling, let's first of all talk about a selling. If you are selling, there must be someone who's buying. If you are buying, there must be someone who's selling. That's how trading operates. There must be someone who's buying when you're selling. There must be someone who's selling when you're buying. So these smart money traders, they exploit these retail traders. How? So when these retail traders are looking forward to buy, these guys are looking forward to sell. When these retail traders are looking forward to sell, these guys are looking forward to buy. And they manipulate the market in such a way. So above market price, it's the premium, and these smart money traders that are looking forward to sell. Below the market price, we have the discount, and smart money traders are looking forward to buy. So the 50% of the Fibonacci gives you a clear defined range, price range, where you're supposed to buy or where you're supposed to sell. So above the 50%, that's where we sell as smart money traders. Below the 50% of the Fibonacci, when you've marked your trading range, that's where you're looking forward to buy. So if you have this understanding that the smart money wants to sell when these retail traders are looking forward to buy, the smart money wants to buy when retail traders are looking forward to sell. So you must always look at the chart in such a situation. If I'm going to be buying, who's going to be selling? If I'm going to be selling, who's going to be buying? Okay, so let's look at a more practical example. So retail traders wants to buy above the market price, whereas smart money traders wants to sell above the market price. They sell at a premium. So when we talk about liquidity pools, we are looking at a collection of orders. The collection of orders, it depends where the market will be. So our first scenario, we're going to be looking at a bearish scenario. We want to look at a bearish scenario. We want to look at a bearish scenario. So in a bearish scenario, the price is moving down. We are in a downtrend. So retail traders above old highs. This is what we call an old high. This one is an old high. This one is an old high. This one is an old high. So above old highs, there are pending orders, or there is an interest that is residing above that old high. So above old highs, you'd see that there's buy-side liquidity. There's buy-side liquidity. What do we mean when we say buy-side liquidity? We're looking for people who would they have a buying interest above this old high. Why? They are assuming that there's now a breakout or a continuation of the bullish momentum. But what you have to think, like, if you go back to what we said, the mentorship program is strategically designed so that you have the understanding of the most important principles. If you look at our mentorship program, the first thing that we talk about is market structure. So on a higher time frame, you are able to identify the structure that is taking place in that particular market. So in this structure, we are looking at a situation where the price is in a downtrend or the price is bearish. But with retail traders, they don't have that understanding of that market structure. They just want to continue buying, even if you can see the market was moving up at this particular level. It was bullish, but the overall market bias on the higher time frame is bearish. So these guys, they're saying that there's still a continuation of a bullish trend. The price is still going to move upwards. But the overall market direction or the overall market bias is bearish. The price is in a downtrend. So what you would see in a bearish scenario where the price is in a downtrend, above old highs, there is liquidity that is residing above old highs. And it is what we call buy-side liquidity. And this buy-side liquidity that resides above old highs is in the form of buy stops. Buy stops, they are looking forward to start buying when the price is broken this level, this price level. So if the price breaks above this old high, the retail traders, they want to buy. So they've placed their buy stops above this level. And we are looking forward as smart money traders to take advantage of this. And in some cases, when the price was moving down, the price is moving down, it's bearish. Let me just change the color here. Here, we have people who have managed to what? To sell. We also have some traders who are selling at that particular level. So what these traders, when they are selling, obviously, their stop losses is placed above this old high. When the price was now moving down, we have some people, some retail traders who have placed their stop loss at this particular level. So the stop loss are residing again above the old high. So the buy-side liquidity, there is a pool of liquidity. We said liquidity pools is just a collection of orders. The orders are in the form of stop losses of those people who were going short, or basically of those people who were selling at this particular level where the price was moving down. They placed their stop losses here. So that's one form of buy-side liquidity, or the liquidity that is residing above this level. And we also have retail traders who are looking forward to buy when price is broken above this previous old high. So the liquidity, or the pool of liquidity, or the liquidity pool, or the collection of orders, or the buy-side liquidity is in the form of buy stops. When retail traders are looking forward to go long, they want to buy here. Or is in the form of retail traders who sold when the price was moving down. So that's the form of what? Buy-side liquidity. So we have buy-side liquidity residing above an old high. And I explained that it comes in the form of buy stops and stop losses. So what smart money traders are looking forward to do is this. They will manipulate the price to move upwards so that it can trigger those buy stops. Because these guys, when they know that there is liquidity that is residing above this old high, so when they manipulate the price to move above, they are triggering the stop losses here. They're hitting all the stop losses that are there. So liquidity, in other words, we are just referring to what? To money. Liquidity is just money. So there is money that is here. Whenever you make a loss, there's someone who's benefiting from that loss. Someone is making a profit when you make a loss. How? When your stop loss is hit, for example here, that is money that you've lost. And I talked about this, that whenever you close a trade, when your stop loss is hit, for example, you were selling here, it was a sale, you open, it was a sale, you open, you automatically open a what? The opposite trade. So here there's liquidity in the form of what? Stop loss and buy stops. And then these smart money, they would then manipulate the price to start moving upwards. So this is what we call a raid on liquidity, or a sweep on liquidity, a liquidity sweep. So the liquidity pool that was residing above this old high was triggered when the price moved above this old high, hitting the what? The pending orders, the buy stops here, and then the price started to move downwards. And these retail traders will end up losing. So you can see smart money were able to what? To manipulate the price to move upwards, and they were able to hit the what? The buy side liquidity. Once that was taken, once that the raid was completed, the raid on liquidity, the price will then start to move upwards. So this is always taking place whenever you look at the market. So one, for you not to be caught on the wrong side. One, if you master your market structure, you have your bias. On the higher time frame, you have your bias. You know that in this particular market, I should be looking for selling opportunity. So when this takes place, according to ICT, he said that we should place our sell limit at this particular level. Why? Because we know that there's liquidity here. Some people, when they talk about liquidity, they say it's the blood that makes this chart move. So you place your sell stop here, while these others are placing a buy stop. You are placing your what? Your sell limit. It's a sell limit that is triggered when price moves up. Yeah, you start selling here. But I'm gonna teach you another entry technique that we can use when we are looking at liquidity pools. When there is a sweep on liquidity or a raid on liquidity. So basically, this is what I'm trying to say, that there will be a selling, there will be a buying interest that resides above old highs, and the price is manipulated, which we call a raid on liquidity, and then the price will start to move downwards. So the opposite is also true. When we look in a bullish, so this was a bearish scenario where the price was in a downtrend. When we're now looking at a bullish scenario where the price is moving upwards, you would see that below the old lows, so this one is called an old low, this one is an old high, this one is an old high, this one is an old low. So below old lows, there is liquidity that is residing there. This or we can talk about liquidity pools, which is a collection of orders. And this below these old lows, there is what we call sell side liquidity. Below old lows in a bullish scenario or in a bullish trend or in an uptrend, there is sell side liquidity. This sell side liquidity is in the form of sell stops or stop loss. There were people who were buying here. Obviously, they placed their stop losses below this old low. So what smart money traders will do is this: they will manipulate the price to go below this old low and hit those sell stops. One, the sell stop will be placed below here because these people are looking forward to when there's a breakout. For example, here there's finally a breakout that took place at this particular level when the price came down. These people, they want to sell, but the mistake that they're making is this: this is a bullish trend, this is an uptrend, but they keep on they also want to sell in an uptrend. So that's the mistake that retail traders would make. So they've placed a sell limit at this particular level, and when the price is manipulated and it comes down here, those sell stops that are selling interest is then triggered, and the price will then be manipulated and start to move upwards. So whenever you are buying, you must know whom you are going to be selling. So what will then happen is this: below these levels, if I'm going to buy here, if I'm going to be a buyer, a smart money trader, I'm going to be buying at this particular level. I want to sell at an old high. So below old lows, they are pending orders. So I know if I'm going to sell, if I'm going to buy here, when price is moved lower, because you're looking forward to buy when the price is now in a discount. So smart money traders are always looking to buy at a lower price. And then where am I going to take my profit? I'm going to take my profit here because I know that there is also buy side liquidity. I'm also going to take my profit at this particular level. So if I'm going to buy here when these old lows, the stop loss that were at this particular level when the price was moving up, they were buying, the stop loss will be hit. So I want to take advantage of that. And also the sell stops of those people who were trying to trade a breakout when the price broke from this particular range. So I want to buy at a discount at this particular level. So according to ICT, he said that we should place a buy limit. But I'm going to show you today a way that you can trade these raid on liquidities, or these when we are talking about liquidity pools. So what you would see is this: when these sell stops have been triggered and the stop loss have been hit, the price will then move upwards, and you would want to take your profit at this particular level. Why? Because there is also buy side liquidity that is residing here. So above old highs, when old high, there is buy side liquidity that is residing that you can also take advantage of. Then up below an old law, there's also sell side liquidity in the form of sell stops and stop loss that is residing at this particular level. So the stop loss of those people were buying when the price was moving up. They place their stop loss here, and the price is manipulated here so that it can hit those stop losses and then it move upwards. So we want to think like smart money traders. You know that the market makers, or those people, the big I think when we started, we talked about smart money traders, or yes, these institutional traders. That's the footprints, or the way they think is the way that we want to think. So they want to hit the stop loss that are here of those people who are buying, and also the sell stops of those people who are wanting to trade a breakout or a continuation of this bearish trend. And these guys want to buy when the price is now lower, and then they sell when the price is now higher. So basically, this is all that is there. So let's quickly look at how we can take advantage, or how we can anticipate raids on liquidity. So basically, that's what we are trying to take advantage of. We are trying to take advantage, or we are trying to anticipate the raids that will be taking place when there is a liquidity sweep or a raid on liquidity here. How can we take advantage of that in that market? So basically, that's what we are looking at. So retail traders wants to sell below the market price, whereas smart money traders wants to buy above, below, not above. They wants to buy. So we are looking at retail traders. They want to sell below the market price when there is a breakout, whereas smart money traders, they want to buy below. They want to buy below. They want to buy below the market price. They want to buy at a discount. So basically, what I'm trying to say is this: retail traders would want to buy above the market price. For example, here they want to buy above this level, whereas smart money traders